Hello, everyone. How are you doing? You're welcome to video 12. As you can see to the upper left of my screen, today we are going to be looking at risk management, why managing risk is important, and then I'm going to be teaching you my risk management model and what are the advantages. So by the end of this call, or at the end of this call rather, you should be able to see the advantages of going by just following this risk management model, right? We all know that there is a lot of risk trading. There's a lot of risk involved when trading Forex. So you being able to manage your risk at the early stage or understanding what risk management is really going to help you in the long run. So I'm going to be looking at risk management, why managing risk is important, and my risk management model and its advantage. I'm going to be explaining that to you. So quickly, let's head over to Google and quickly let's look at I've already done the search, what is risk management in Forex? And I can just zoom this and show you, it says Forex risk management enables you to implement a set of rules and measures to ensure any negative impact of a Forex trade is manageable. Okay, an effective strategy requires proper planning from the onset, since it's better to have a risk management plan in place before you actually start trading. Now, this is a very good definition, but it embodies all what I want to talk about today. So let's take it one by one again. It says Forex risk management enables you to implement a set of rules. So it actually there's going to be a set of rules we are going to come out with at the end of this call, which I want you to follow. That is the same risk management principle I have been using for a very long time now, and it has been good. All right. So Forex risk management enables you to implement a set of rules and measures to ensure any negative impact of a Forex trade is manageable. Now, the word that negative impact means losses. Okay, in as much as we do not control the markets, remember in one of the videos you have watched already, talked about the Forex market is the largest financial market is it the largest market in the world? And when we talk about Forex, the amount of money that goes around in circulation is going to a total of $7 trillion every blessed day. So now there's a lot of money in circulation in the Forex markets. What this means is that there is a lot of money to be made, and there's a lot of money also to be made and to be lost. Okay, so you can lose a lot just as how you're going to make a lot. So it is important for you to be able to manage your risk because we do not control this market and we do not have the amount of money it takes to push price in our favor. So if we cannot control price, if we do not have what it takes, if we do not have the financial capability of moving price in our favor, therefore there's every tendency that every trade we are going to take has a potential of becoming a loss. In as much as the trade all the checklist can align on the trade, there is still every tendency that that trade can actually result to a loss. So what happens in a scenario like that? You need to manage your risk ahead. So when stuffs like that happen, you are not badly affected. As you can see, implement a set of rules and measures to ensure any negative impact of a Forex trade, that means any pair you're buying, is manageable. So that if you take a loss on that trade, it will not affect you to the extent where you do not have any other money to trade again. So for example, you have $100 in your account. You don't want to be taking a trade with about $80 stop loss. In just one trade, you've lost 80% of that account. That is not wise, not reasonable. Okay. I know there are a lot of people that preach out there. You buy here, sell with two different accounts, which is the amount of money you're willing to they buy it, like the front two accounts, and then they buy full margin and sell full margin on one. Yeah, but I will not teach you that. Okay, it is good to manage your risk. Okay, it's good because if you are doing that style of trading, then therefore there is no need to go for knowledge because since the market is definitely going to buy or sell, I can just go in every time with two accounts, I buy and sell one. I don't need to learn any other thing. I just buy and sell, and then one will become profitable, and then I lose on the other one. I can recover it if price is really moving in the other one. So you see, but then if you really want to learn the art of trading, how to really trade and not do this, go by that way of trading, then you need to be able to manage your risk. Okay, managing your risk is very, very important as a trader because number one, you do not control the market. Therefore, every trade you have marked out, there's a tendency that that trade can go against you. So when you have that at the back of your mind, you're getting in on every trade with an agreed risk. Okay, I am not risking more than $10 on this trade. So the worst case scenario is that the price broker is going to close you at a $10 loss. If there is no news, nothing involved, broker will close you at a $10 loss. But we have some cases where news comes out and there is a gap in price, very fast movement, and then price fail to close at the break even or where your stop loss is, like price fail to respect the stop losses. So we do have that in some minor instances. Okay, so now let's come to the second part. An effective, see it now, an effective strategy. So an effective trading strategy requires proper planning from the onset or from the outset. So outset is even before you are getting in on that trade. You've already planned out your risk. You've planned the amount you're risking, the amount you want to take from the market. Because in as much as you're planning how much you're risking, also plan how much you want to profit out from that trade. Okay, so an effective strategy requires proper planning from the onset, since it is better to have a risk management plan in place before you actually start trading. So that is why I'm teaching you this topic even before we go into the real stuff, even before we start going into smart money and all. I'm bringing this topic forward so you can have an understanding and a mindset already, or a mindset, a particular approach on how you're going to attack the market when you actually start trading. Okay. Yeah. So that is it. Forex market, the Forex risk management enables you to implement a set of rules and measures to ensure any negative impact of a Forex trade is manageable. An effective strategy requires proper planning from the outset, since it is better to have a risk management plan in place before you actually start trading. So that's why I decided to bring this up before we even go into smart money and I started to teach you all of those stuff. Okay, so that is it about the definition of what risk management is. And from the definition already, you can see answering question number 2, why managing risk is important. So why do you think we need to manage our risk? Why do you think we need to manage our risk? So let's go. Why do we need to manage our risk? Okay, let's go. Number 1, um, uncertainty. Uncertainty of price direction. So number 1, uncertainty of price direction. What this means is, in as much as we do not control the market, we can do our analysis and say this is where price is going to go to. And then price actually will respect our analysis and go that way. But one thing you need to know is that it is not because of you placed a buy limit. That is why price comes and activates you, and the market just wants to favor you. There is nothing like that. So take it off your mind when you get in on a trade and like price moved because I wanted it to buy. You understand? So yes, you can do your analysis, know where price is going to get to and reject, but then we do not move price. Okay, and there is every uncertainty because so why do we need to manage our risk? Number 2 is we can say number 2 is because we do not control the market. Okay, so because we do not control the market, that can lead to uncertainty of price direction. If I can control the market, then there is no need for me to be worried about uncertainty of price direction, since I can move price to wherever I want to. Are you seeing it now? But because I cannot move the market, and why do you think I can move the market? Or why do you think we can't control the market? Because we do not have the equity in order to control the market. So if we say, why do we need to manage our risk? Because we do not have, we can also say number three, because we do not have the equity to move price. So you can see everything I've been saying now, they are all related. So we do not have the equity to move price. Therefore, we cannot control price. Therefore, there will be uncertainty of price direction because we cannot tell where price is going to go to. So you feel me? That's it. So I don't know where price is going to go to. In as much as I know where price is going to go to, you can be at the end of this training, you should be able to tell market direction. When you see a price chart, you should be able to say Euro USD will buy from here. GBP USD should buy from here. You understand? You can call market tops and bottom. You understand? But then it is not certain. Why? Because we do not control the market. And why is it that we cannot control the market? Because we do not have the equity to move price. Okay. So the market is being moved by these top institutions, which I'm going to be explaining to you in video down. Right? But these institutions have a very big amount of money they use in trading Forex, and then they move price in their direction. So because we now do not have the equity and we do not have access to them, so why do we need to manage our risk? Number four can be lack of access. Okay, lack of access. What do I mean by lack of access? So now, people that move price, the people who move price are human beings like you and I. You understand? If they're actually human beings like you and I, therefore, if, for example, I have access to them or I have access to somebody that is working like very big, one of the top people that move price in the Forex market, if I have access to the person, it can be easy for me to, just, hey guy, what's up? Alpha, which one are we buying? And I'll be like, okay, so time, you CP high, we are gonna take Euro USD to the upside. So now I have the benefit of access. Therefore, I mean, to hell with risk management, right? Because if they have told me they're buying, they want to take CP high to the upside based on this, all I need to know is where are you moving price to today? And then they say, okay, we are taking price to the upside, starting from this price level. Oh boy, I'm in with full margin on my account because I'm leveraging on the institutions to move price because I was able to get information, benefit of access to whoever is going to move price and be like, this is what's going to happen. And then I'm buying. See it now? So yes. So, but then we do not have this access. So we need to manage our risk. Okay. We need to manage our risk because we do not have this access. So again, four reasons why we need to manage our risk. Number one, uncertainty of price direction. Number two, because we do not have control. We do not control the market, or we do not have control of the market. Three, because we do not have the equity to move price. And number four, lack of access. Okay, number four, lack of access. So what I'm going to do is I'm going to give you a quick, there's going to be a quick homework exercise now. I've given you four. I want you to give me three more reasons why you think we need to manage our risk. So homework exercise quickly. Okay, give me three more reasons why we need to manage our risk. Okay, so give me three more reasons why we need to manage our risk. So I'm just going to copy this quickly. Take a screenshot of it, rather. Okay, so there we go. We have that now. That's homework exercise one. So let's see, maybe at the end of the call, there might be another homework exercise, right? So yes, I've explained number one, and then what we're going to talk about number two, I've also explained that, and there's an homework exercise for you. Now, the third one, this is where we're going to be spending quite a number of time. My risk management model and its advantage. Okay, so I'm going to give you my risk management model. This is how it looks like. Okay, so I'm going to agree that we're going to start with an hypothetical balance of 500. Oh, okay. All right. So, um, like I said, we're going to use an hypothetical example of, let's say, a starting balance of $500. So starting the account with $500. So a starting account balance of $500. Okay, so this is what we're starting with. So let's say you have a starting balance of $500. And another thing is, I always make sure that anytime I'm getting in on a trade, my first TP is at 3 times what I'm risking. So that's one of the nugget there. I always aim for 3 times what I am risking. And why do you think it is important? Or what do you think are the benefits of going for a reward of 3 to 1? So just pause this video now and just think about it. What do you think would be the benefit of, of going for a 3 reward to 1? What can be the benefit? Oh, I have to take more, I have to take less trades in order to be profitable. Something like that, right? Oh, just one trade, I'm up 3%. I'm up 3 times, right? So all of those things start coming to your head. So now let's put all of this into right here now. So I always make sure that my risk is calculated. And number two, my reward is also calculated and at 3 times what I am risking. Okay, so number one now is the rules. Let's put this as okay. Number one, have a defined risk per trade. So make sure that you have a defined risk per trade. Okay. Number two, have a defined reward per trade. Or have a defined reward per trade. So have a defined risk per trade, have a defined reward per trade. Number three, or this number three, we can also put this number three in number two, which is 3 times profit target of 3 times what you're risking. So aim for 3 times. Um, aim for 3 times profits. Should we put it that way? Aim for, or we can say profit of 3 times the risk. Oh, no, no, that's not the right word. So we can just use number one and two. Since number three is in number two, number one, have a defined risk per trade. What do I mean by having a defined risk per trade? So don't just get in blindly. Don't just get in because you just want to get in, right? You see price is ready to buy, you just jump in with any lot size. You're not even sure what the risk is going to be. You just get in. So number one, have a defined risk per trade. Number two, have a defined reward. So if we decide to split these two things now, number one, okay, having a defined risk. So how do you have a defined risk? How? How do we have a defined risk? That means you have to go to TradingView, or you need to first calculate what percentage you want to risk per trade. That is how you start to have a defined risk, right? So, should I say the first thing you do is you go to TradingView, you do your analysis, and you first check what is the stop loss of this trade. You try to first determine where your stop loss is going to be, right? Then when you gotten what the stop loss is going to be, I've taught you how to determine your lot size, right? I've showed you how to get the lot size. You go to PEEP value calculator, you input the value per PEEP, multiply, you get the value per PEEP, then you multiply the value per PEEP times the stop loss in pips also. So if the stop loss for the trade is $10 and Euro USD value per pip is $10, that's going to be $100. So if you are risking $50, it's going to be $50 divided by 100, which is going to give you, I think, 0.50 divided by 100. I'm thinking 0.05. I hope I'm correct. So 50. Oh, no. 0.50 divided by 100. That's going to be 0.5. Yeah, sorry. 0.5. Okay, that's the lot size you're going to use for that trade. See, you've gotten the lot size. That lot size, if you use 0.5, is going to accommodate a 10 pip stop loss. So if price decide not to go your way, the broker will take you out at a 10 pip stop loss. All right, so number one, having a defined risk. How do you have a defined risk? Number one, determine the stop loss. Determine the stop loss area on TradingView, right? You need to determine where the stop loss is going to be on TradingView. Are you with me? That's how you define the risk. Determine the stop loss area on TradingView. Yeah, you need to be able to determine that on the TradingView even before you start doing all of the calculations and all. And then how do you have a defined reward? Same thing, determine the take profit area on TradingView. And then you can have various take profit area, but make sure that your first TP is at 3 times what you're risking. Okay, so the rules have a defined risk per trade. How do you do that? By determining the stop loss area on TradingView. Number two, have a defined reward per trade. So under this number two, now we can say having a defined reward having a defined reward. How do you do that? Okay, 3 times what you're risking. So risk to reward ratio, RRR ratio, should be at least 1, 2, 3. So what that means is risk of 1 to reward of 3. So I can say, for example, that is 100 $100 risk to gain $300 profits, or let's use reward. That's it. So that's how I always do it. I always make sure that every trade I am taking is giving me a minimum of 1 to 3 weeks reward. You can go to the Instagram page and check all the markups. Minimum of 1 to 3. And why is that? Why do I do that? Now, let's look at the importance of this now. Because let's say, now we're going to come back here now, a starting balance of 1,000. And I am risking, whatever I'm risking is going to be 3 times, I'm going to make 3 times that. Okay. And I have a starting balance of 500. And I decide that, okay, 500 now is my balance. How much of this 500 am I willing to risk? How many percent? So I can say, okay, I want to risk, if it is 10%, 10% of 500, I think is 50. Okay, so you're saying $50 per trade. So you're risking 10%. Or am I correct? Let's check the calculator quickly. So 10, so $50. That's it. So 10% is $50. If you say you want to go in with 5% risk, 5% is going to be $25 per trade. I know some people say risking 10% is too much because all you have to do in order to lose their account is to take 10 consecutive losing trade and all the money in the account is going to go. Because if you take 10 losing trade, it's going to be 50 times 10 is going to give you the balance of 500. So if you take 10 losing trade, you're going to lose all the money you have in your account. But what happens if you divide the risk again to even 5%? Further reduce it to 5%. So if you are reducing the trade, you're risking out to 5%. That means reducing the risk means a greater number of trades you have to take in order to lose the account. Remember, if you risk 10%, all you have to do is take 10 consecutive losses and the account is going to blow. If you reduce the risk to 5%, you have to take 20 trades in a row, 20 losing trade in a row in order to lose your $500. So we can say $25 multiplied by 20 times. That's going to give you 500. So can you see, just by reducing my risk now, it gives me even more advantage to take more trades. So 20 consecutive losses, I will lose my $500. If I was risking $50, I just need 10 consecutive losses and my account is gone. So you see, make sure you've planned all this before you even start to take a trade. So when you fund your account newly, how much am I willing to risk on this trade? Then as the account is increasing, you can start to maybe increase you should get, like the way I do, you should get to a certain number before I can even think, okay, I want to change the risk. Okay, because now you can't get in on trade. Your percentage risk, how do I put it now? The amount, now you can either go with percentage risk or dollar value. Or how do I put it now? What I'm saying is you can't decide that you want to risk 10% per trade or decide that for every trade you want to be risking $50. That's 10%, right? So now what happens in this scenario is that if you go that for this $500 now, I want to risk $25 for every trade. That means if the account is at 700, you're still risking $25. But if the account is at 700, that $25 is not 5% anymore. See it now? Yes. So quickly, let me show you the model. Okay. Now a starting balance of $500, risk to reward of 1 to 3. Okay. Risk to reward of 1 to 3. Every trade. Now, another thing you need to do is have an agreed number of trades you want to take in a week. I still talked about this to the general group last week. Have an agreed number of trades you want to take in a week. That's going to help you really plan your risk management. That is one thing that is very important for you to always have. Make sure you know the amount of trades you want to take in a week, how many trades you want to take in a month. So that way you've calculated everything already and you're working in line with what you have calculated. So I can say, for example, I want to take, let's say, 10 trades. So 10 trades in a week. All right. So 10 trades a week. So that's it. I want to take 10 trades in a week now. Now, if I'm taking 10 trades in a week and I have an account balance of 500, I'm aiming for 1 to 3 risk reward. In this 500, I've decided that I want to risk 5%, which is $25. So that is $25 per trade. Okay, $25 per trade. Now, what is going to be the best case scenario What's going to be the worst case scenario? That's what we're going to find out now. So we're going to start from the worst case scenario to the best. So let's start from bad to good. Or should we start from good to bad? Okay, this time let's start from good to bad. Okay, so now what is going to be the best case scenario now? The best case scenario is that we are going to have 10 wins, okay, and what? 0 losses. 10 wins and 0 loss. See it now? If you have 10 wins and 0 loss, what do you think is going to happen to your account? So you have an account balance of 500. Okay? You have an account balance of 500. And remember, for every trade you're taking, you're risking $25 per trade. So if I'm risking $25 per trade and my first trade is actually a win, I'm going to end up making 3 times 25. That is $75 on that trade. So $75 for one trade. Now, if all the 10 trades are win, it's going to be 75 multiplied by 10. That's $750 profit aside the balance now. So now, if you have 10 wins in a week, no losses, your balance will be 10 wins, 0 loss. Balance. Your balance will be at 750 now plus your 500. $1,250. Balance at $1,250. Now you are profitable. You are profitable by $750. So let me just adjust this. So balance adds. So you see, 10 wins, 0 losses. Your balance at the end of that week will be $1,250. You will be profitable by $750. So what happens now if now we are starting from the best case scenario and worst case scenario? Now, by this, are you profitable or not? Definitely very obvious. You are profitable, so we can make this green. All right, so now we're going to bring this down and just change it. Okay, so now what happens if you have 9 wins? Oh, sorry, 750. So what happens if you have 9 wins? Okay, and you lost 1 trade. What happened now? So if we have 9 wins and we lost 1 trade, remember that every trade is $25 per trade. So if you took the first trade and you lost that trade, your account is down to $975. No, I'm sorry, 475 rather. So if you have a $500 balance and you lost 25, you have $475 balance. But then what happens? Before the end of the week, the next 9 trades were winning trades. What do you think would have happened to your account? Remember, every one winning trade is going to give you $75 because you're risking 25 to make $75. So 75 multiplied by 9 is going to be $675 profit. Now, if you add this to your balance, remember your balance was at 475 because you've lost the first trade. Okay, so 675 plus 475 are going to have what? $1,150. That's going to be your balance. So balance of 1,150. Profitable by 675. You seen it now? Even though you took 1 losses, even though you took 1 loss and the other trades were win, you were still very, very profitable. I mean, you more than doubled your account here. Okay, now let's do something before we make it easier now. Let's go again. So now we have the next one here. This is another case scenario where you have 8 wins, okay, and you have 2 losses. So let's say at the end of the week, you couldn't get all the trades, you lost 2, and you made about 8 wins. What's going to happen? So if you lost 2 trades, remember one trade is $25. If you lost 2 trades, that's $50 already you've lost. Your account is going to be at $450 balance. And then you won the remaining 8 trades. So that one trade is 75 multiplied by 8. That's going to be $600 profit. You see? Are you with me now? $600 profit. But then if you had the 600 to the balance, remember the balance was at 450 already because you've lost 2 trade. So if you had it plus 450, they're going to be where? $1,050. So your balance is going to be 1,050. And then you were profitable by $600. That's it. At the end of the day, at the end of the week, you are still profitable. So now, if you notice, there is a simple mathematics that is going on here now, right? All we have to do is minus this by 1, add the 1 to this. And then this year, there is a common number that is common among all of this. So if you do 1,250, you minus it from 1,150 minus 1,150, it gives us an $100 gap, right? And then we have this again minus this. So if we subtract 1,150 minus 1,050, we're going to see what? 100. So that means there is a constant 100 that is being subtracted here. So we know that now. I'm going to make it easy for us now. And then this one, there is how much is being subtracted here? Let's see, 750 minus 675. $75 is being subtracted. And then when we remove 75 again, we get 600. So there is every reduction of 100 and a reduction of 75. It makes it easy for us to finish this illustration faster. So now, come here now, we have 7 wins. Let's say you ended the week with 7 wins and you had 3 losses. Okay, what is going to happen? Well, where is the balance going to be now? Quickly, all we know now that we're just going to remove 100 from that 1,050 minus 100. That's going to give us 950. So our balance is going to be at 950. Okay, 950. And this one, we are going to remove 75 again from this 600. Okay, so 600 minus 75, we're going to be at 525. So come here, profitable by 525. You see? So 7 wins, 3 losses. If you had 3 losses and you won the many 7 trade, you will still be profitable by $525. That's more than, no, balance at 950, profitable by 525. Oh, is this correct now? Coming. So if you had, I think it is, just a little bit confused now. So each trade is $25, right? So if you lost 3 trades, you are down 75 from 500, the balance would be at 425. Okay, and then you won the remaining 7 trade, which is going to be 75 multiplied by 7. Okay, 525 plus 425. 950. Yes. So your balance is going to be 950. So you can see, although you're still profitable, because you started your account with 500 and your balance is at 950. Okay, but then you took 3 losses, so you had to recover those losses before, but then you're still profitable. You can see, right? So even though you're risking $25, if you can have 7 wins, you will be profitable and your balance will be at $950 at the end of that week. So what happens now, if we take this now and then we bring this down again, and then we say 6 wins, okay, this time is 6, and then you took 4 losses. Okay, so we're going to remove 100 from 950. Our balance is going to be at 850. Okay, and then we're going to remove 75 from 525. So 525 minus 75 are going to be at 450. So we're going to be profitable by 450. Okay. And then we go down again. You're still profitable. Even in as much as you had 4 losses that week, you're still profitable. And why do you think this is possible? Because you are going by a risk reward of 1 to 3. If you were going for a 1-to-1, it would have been different. Okay, so even though you have 4 losses out of 10 trade, you should still be profitable. Now let's check what happens if you had like break even, like 5 wins and you had 5 losses. 5 wins, 5 losses. What's going to happen? So we remove 100. Okay, we remove 100 from 850. This is going to be down to 750, right? And then we remove 75 again from 450 minus 75. 375. So you're going to be profitable at the end of that week with $375. Okay, you seen it now? $375. That's cool. So let's see. So even though you had 5 wins and 5 losses, I mean, you won 5, you lost 5, you're still up a lot, right? I mean, you started the account with 500 and you're at 750. That's extra like 250. You had extra, even after recovering all the losses you are taking on the account. So what happens if the scale starts to go against you now? Like you start to lose more than you win. What happens? So if you're losing more than you win, what happens? Let's see. So now you had 4 wins and 6 losses. Now the losses are getting big, right? Should you start to panic? Let's see. So now if you lose 6 trade, consistently risking $25 per trade, risk to reward of 1 to 3, and you lost 6 trade, your balance will be at 650. Okay. And you're profitable. If we remove 75 from this, you are profitable by $300. Like, oh my God. So even though I'm losing more than I'm winning, if I lose 6 trade, oh my God, 6 trade lost. And then I won 4 trade. You should still have a $650 balance at the end of that week. You've recovered all the losses you've made, and you still made extra $150. See? So we can even do something like this and say, um, we can say, maybe I come forward and put, um, you started the account with $500, right? And this 10 wins gives you 1,250. You've made extra $750. Eligible. You're eligible to withdraw. Eligible to withdraw 1,250 without. You're eligible to withdraw 250, leaving the initial balance in the account. Initial balance of $500 in the account. You see it now? Cool. So we have to do that for all of this now. So quickly, you can say, so this also you are eligible to withdraw. How much are you eligible to withdraw here now? You can withdraw a total profit of, if you remove 500 from 1,000, you have 500 left. So this one you can withdraw. No, eligible to withdraw. This you're eligible to withdraw 750. Oh, I think it's the same thing, right? No, it's not. No, it's not. Because when you have 8 wins, you're eligible to withdraw 550. Okay, yes. Okay, yes. So for 9 wins now, 10 wins, you have a profit of 1,250. If you remove 500, you still have extra $750. No losses. Okay, but in 9 wins now, 9 wins, you should be able to withdraw $650. Yes. So eligible to withdraw. No. Aha, yeah, this one is wrong. I'm supposed to, this is eligible to withdraw 750. Yeah, 750. Exactly. $750, leaving the initial balance of 500 in the account. Yes. And then for 9 wins, you should be eligible to withdraw 600 and $650. $650. Again, leaving the initial balance of 500 in the account. That's it. And then this one also, this one also, uh, this one also, you should be eligible to withdraw. Should be eligible to withdraw $550 on this trade. Should be able to withdraw at the end of the week. You should be able to withdraw 550. Yes, 550, leaving the initial balance of 500 in the account. All right, so what I'm going to do is I'm just going to copy all of this so it can be fast and just paste it. So for this one also, I can come here and just do something like this, and I can click on paste. And then I just put it to the front. And then for this, we should be eligible to withdraw. This one, you should be eligible to withdraw about give or take $450 exactly. $450 on this trade. Leaving the initial balance of $500 in the account. So is there something that's making sense here? I think 100, 650, 750, 650, 550, 450. So everything is 100, 100, 100. So I like that. It's going to make it easy now. Paste and then come here and then we just remove this from 450 to 350. Definitely. And then this one will be 250. Okay, this 250. No, that's 350. Yeah, this is 250. Exactly. So eligible to withdraw 250, and then you can still leave the balance. Okay, and then this one also, this one you should be able to withdraw about $150. So eligible to withdraw $150, leaving the initial balance of 500 in the account. So what happens now if you have 3 wins? Let's see. So now if you have 3 wins and then you lost 7 trades, what happens? Your balance, which is reducing by 100, is 750, 650. This would be at balance would be at 550. Okay. Profitable by, so we were removing about 75, right? So the last one was 300. We just removed 75. 225. So profitable by 225. Okay, profitable by 225. Now, how much are you eligible to withdraw now? It's very obvious that you can only remove $50 from this account. You see now, you can only remove $50 from this account unless you want to touch your balance. So you see, $50, that's it. So even though you lost 7 trades, you could still you would have withdrawn about $50 from that whole trading week, and you are still profitable, even though you lost way more than you won. Power of risk to reward. So you can only withdraw $50 unless you want to touch your balance. So what happens now if you have if it goes below 3? So let's say you have about 2 wins and 8 losses now. This get bad. It starts to get bad here because 2 wins, 8 losses. Oh boy. So now your balance is going to drop again by 100. So it's going to be 450. Okay, then we remove 75 again from 225 minus 75. That's about 150. Okay. Now you're not even profitable anymore. Okay, because if you have 2 wins and you have 8 losses, your balance is going to drop to $450. Okay, your balance is going to drop to balance is going to drop to $450. Loss to recover of $50. So you have $50 loss to recover now. So you're not even profitable and you're not even eligible for withdrawal anymore. So we can just take all of this away. You're not eligible for withdrawal anymore. And we can say loss to recover, loss of, now how much loss do you need to recover in order to go break even? You just need to recover $50. Okay, so loss of 50 to go back to initial balance. Okay, so we can just put this as red since you were not profitable. But now look at something. I want you to see something here. You were to take, like, you plan to take 10 trades in a week and you lost 8 trades, like 8 solid trades. But then your balance is still at 450. Is that not insane? In as much as, yes, you did not end up becoming profitable, but then is this not insane? 8 trades, but you still have a lot in your account. So just think about it. Amazing, right? Amazing. Power of risk to reward. That's it. And you have to be consistent. All of this principle will not work if you are not consistent with your risk. And a lot of things can come in that will make you not consistent. You can have 2, 3 wins and the wins get to your head and you decide that the next trade you want to risk more than what you've agreed on because you want to make big money fast. See? And then number 2, you close the trade prematurely. The trade did not get to 1 to 3, you just close it. So a lot of factors can begin to come in now as to why all of these things might not be realistic. It can't be realistic if you follow it, your discipline, but then it can, in as much as it is very easy, it is still very hard to follow. You will see it. So I'm teaching you now. I'm sure as you're watching this recording now, you're fired up and like, this is what I'm going to do. But then it is easier said than done. That's it. Can you follow this consecutively? This is the amount I'm going to reach this week. I'm going to take 10 trades this week. And you are diligently looking for those 10 trades. And you made sure that, yes, you took 10 trades in a week. Yes, 1 to 3 reached the reward. And how you planned it, you were able to go through everything before the week ended. Can you do that? That's where the real work is. All right. So now, if you have 2 wins, 8 losses, you cannot withdraw on this account because you have a loss to recover. Okay. And how much loss do you have to recover? Just $50. $50. Just one more trade will take you back to profit. So what happens now if you lose, you had just 1 win and you lost about 9 trades? I know when you lose 9 trades and win just 1, this can mess up your psychology a whole lot. But then I want you to see something. This is $350. You have a loss of $150 to recover. Seeing it now? So $150 to recover. And you see it? So it's not that bad after all. I mean, I lost 9 trades. I won just 1. And I mean, if you do this diligently, one thing I'm going to tell you, if you do this diligently and you actually lose 9 trades and win 1, you will not feel sad. As in, your level of sadness will not be like, it will not be the same like when you did not follow your risk or didn't do anything and you have big losses. You will not feel that same level of sadness. Not as much as you will not be happy, but then you will still be feeling happy. Not happy, you will still have this, you will not really feel too sad because you actually followed what you had planned out. And then what you've already known that this is what worst case scenario, if I lose 9 trades, I'm going to be at 350. And at the end, you actually got to that 350. That's you planning the trade and coming out with the result, even though it wasn't a positive one. And then let's go to the worst case scenario. Now, the worst case scenario, which I do not pray for anyone, is having a 0 win. Okay. 0 loss, a 0 win rather. 0. You didn't win anything. And then you lost the whole 10 trades. Now, this one, if you lose everything, your account is going to be at $250. So the worst case scenario, you're going to lose half of your account. And then it's going to take you, in order for you to recover your balance, to get to 500, you have to make about $250. Are you seeing it now? You lost all the trades. Just half of your account was gone. And this is not good. So now, let's look at it again. And where is the break-even point? The break-even point is going to be at this 3 wins. So we can give this another color. Right. So this is the lowest you want to go for. 3 wins. You can have 7 losses, but make sure you're striving for 3. Now, another important thing I need to tell you, which you're going to be watching in phase 2 as regards psychology, is that there is a random distribution between the wins and loss. And what do I mean by this? There is a random distribution between wins and loss. What I mean by this statement is that you cannot tell which trade is going to be a winning trade or which trade is going to be a losing trade. Therefore, the order in which they come, you will not know. So if you plan that at the end of the week, you want to have, like, at the end of the week, you are aiming for 3 wins and 7 losses. I just say worst case scenario for you, right? That's your worst case scenario you want to have. But now, you cannot tell how it's going to come. It can come in the form of the first trade is a win, the second trade is a win, the third trade is a win, and the remaining 4 trades you will take will be losses. I mean, the remaining 7 trades. There is a random distribution between how it's going to come. It can happen that this win, this third win can come to this fourth loss, and the fourth loss can come to this area here. So it can come like win, win, loss, and then followed by 3 losses again, loss, 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 and then win, and then loss, loss, loss. You cannot tell how it's going to come. It can even start with a very bad week, loss, 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 and then loss, and then win, win. That is 1, 2, 3, 4, 5, 6, 7, 8. Right. So you have 2 wins, and then loss again, and then win. So you cannot tell the order in which is going to come. With this understanding, this will go a long way helping your psychology. So when you take a trade or when you are taking consecutive losses, it's not like it will not be getting to your head anymore because already you know there is a random distribution between the wins and losses. So you cannot tell the order in which it's going to come. It can come as 4 losses at first. You mark up the chart, you set the trade, you hit stop loss. You mark up the chart, you set your trade, you hit stop loss again. You can't tell. But then you have something at the back of your mind. There is a random distribution between the wins and loss. Before I can really get sad is if I start to have like 7 losses already, then I know the last 3 trade needs to be profitable. That's it. But when you have 4 losses, I mean, come on, there's still time. You see it now? People don't understand this stuff. That's why they take losses and start to get affected. So there is a random distribution between the wins and the loss. It can come in different form. Okay? Yes, sir. So now, looking at this now, the minimum you always want to aim for is 3 wins, 7 losses if you are going for 10 trades in a week. Now, this is a template you can use. It doesn't have to be 10 trades in a week. You can decide you want to have 5 trades in a week. 1 trade per day, like 1 trade per day, 1 on Monday, 1 on Tuesday, 1 on Wednesday, Thursday, Friday. And you're risking a certain amount of money, going for 1 to 3 risk reward. If you are going for 5 trades in a week, how many trades do you need to be profitable? Do you need to have in order for you to be profitable? I'll leave that to you to check. If you want to go for 20 trades in a week, you do the calculation. How many trades do you need to have? So this is a template you use, and then you come out with how many trades you want to take, all of that, and then use this template to determine what is going to be your minimum threshold. Right? Exactly. So this is the risk management principle I've been using and I've been teaching for a long time. Never gets old, right? And I have taught it to you now. So if you enjoy this call, just go to my DM and just drop a fire emoji. You don't need to say anything, just drop a fire emoji. And then I will remember that, okay, this person has watched risk management. All right. So if you have any questions, please feel free to send it to the SDF question group. When I see it, I will attend to it. Okay. So I wish you all the best in your trading journey. After this topic, we are moving into the real deal. Okay. So do have an amazing day. Bye-bye.